Good morning, everyone. Thank you very much for having me. I'm Sebastian Widmann. I'm head of strategy at Komainu. Komainu is a regulated digital asset custody solution built by institutions for institutions. So we basically secure digital assets at scale. A couple of our partners here, including Ledger, who kindly launched a joint venture with us in 2018. To give you a perspective today is really a couple of messages. On one side is that we're still very early. Institutions are just dipping their toes. And secondly is that digital assets, or the current form of digital assets we know, are really just 1% of the total addressable market. Every asset, financial or non-financial, will be represented on a digital ledger. And the role of custodians for institutions as well as for individuals will become increasingly important. Quickly on Komainu, we launched in 2018. It's a joint venture between Ledger, the French technology provider, CoinShares, which is a leading digital asset fund manager, and Nomura, the global Japanese investment bank. I'll give you a bit of a story as to how Nomura and the three joint venture party thought about the initiative back in 2018, where we are today, as well as where we want to go in the future, to really give you a bit of a sense as to how early we are in this next wave of institutional adoption. Komainu, interestingly, was launched through the last bear market. So Bitcoin went to around 20,000 in 2017. Everyone got interested, and then it started cooling down again. I think we're in a very similar period right now, and it's impressive the difference, because on one side, institutions are much more interested now to tip their toes, and secondly, more and more infrastructure is currently available in the market. So quickly on that, Komainu at its high peak had around 9 billion in assets under custody. We operate in a number of jurisdictions. We're regulated in Jersey. We have offices in London, Singapore, looking at Dubai as well as Japan. And we're also operating in the US. And the idea is really to create a globally regulated digital asset custody solution to act as gatekeepers for institutions to move into this asset class. So quickly, to give you a bit of a perspective as to the background of Komainu, a number of banks, and I think most banks to date, still don't really focus on crypto assets. So anything that we think, or we're going to hear mostly about today, is really related about Bitcoin, cryptocurrencies, non-fungible tokens, as well as utility tokens. Every bank is much more interested in tokenized assets because that's the current business model. So I joined Nomura in 2017. At the time I was looking, and prior to that I was doing a lot of research on distributed ledger technologies. How can you create stablecoins, digital securities, but also how can you create new types of digital assets? At the time when I joined the bank, there was a lot of discussion. It was permissionless blockchains versus permissioned blockchains. Every bank, given the regulatory ramifications, was really only focused on permissioned blockchains. So at the time they said, and Nomura was a prime example of that, is how can you disrupt your own business model before third-party startups disrupt it themselves? So Nomura invested in a company called R3, which has a permissioned blockchain called Corda, and really started dipping their toes and experimenting around permissioned blockchain protocols to look at how can we create digital currencies, digital replicas of the euro, the yen, the dollar. How can we create digital stocks, anything from an Apple stock to the company stock as well. Commodities and real estate, because that's really the bread and butter of any financial service institutions. The addressable market of tokenized assets is a couple $100 trillion versus crypto assets, which is still 1 trillion and less. So at the time, the bank really started to look at, if this technology were to be replicated in the traditional financial landscape, how can we as a bank really prepare ourselves to service our clients and to be competitive? Nomura is over 100 years old, so it had to go through these cycles a number of times. With every technological paradigm, there is a chance for disruption. And as a Japanese bank, they really wanted to disrupt their own business model before then. What was quite apparent also in our experiments around 2016, 2017, was that digital assets are in nature bearer assets. So if you don't hold the keys to that assets, then you don't really own the assets. And if you get hacked or you lose those, then you really lose the asset or the right to have that asset itself. And we knew that this would be replicated. It was a new phenomenon. It's present in gold or other commodities where you actually have to hold the asset, but it wasn't really relevant for securities or other financial products, given that you had the role of custodians. So really took research. And the idea for Nomura was, if we want to service an asset like Bitcoin or a digital security, the way we service traditional assets to date, we really need to create end-to-end digital infrastructure. So from issuance to trading to lending to data products, as well as the custody angle. My role at the time, and around 2017, there was Bitcoin at 20,000. A lot of institutional clients expressed interest. I tried to convince the bank to start trading Bitcoin. Most of the on-ramping, meaning from fiat to crypto, was being done in Japan. And Nomura, being the biggest FX franchise in the world, we started initially to try to pitch them to say, let's give our clients access to Bitcoin by giving them fiat rails to be able to adapt some of the Japanese exchanges. Quickly, legal and compliance and the regulators shut us down for a couple of reasons. Main one was that on one side, there was no regulation in the ecosystem, so no one knew, was Bitcoin a commodity, was it a security, was it a currency? And then more importantly for us to get comfortable to actually give our clients access was there was no real infrastructure in the space. So we looked at exchanges, they were very retail focused. We looked at custodians, they were non-existent. And so we took a step back and said, if this overall ecosystem was to grow, what are the different pillars that you would need? We knew, given that these are bearer assets, the foundational pillar of every institutional strategy would be custody. And so we looked at the ecosystem, we said, should we invest in a custodian? There was nothing fit for purpose for us. So really started looking at the research, how did custody evolve? Where is it today? How did it evolve in financial products? And then look at the custody of digital assets, namely Bitcoin at the time, and see how that would impact. So very quickly on custody of financial products, I think custody is one of the oldest financial services in the world. It started with grain even before Christ. It then moved to custody of commodities, which hasn't changed to date to some extent. You have gold kept in vaults globally. And financial securities really started the advent of financial services custody and asset servicing. So the first physical certificates of stocks were issued around 1606, the Dutch East India Company. Those were bearer assets in essence. So the stock certificate was a physical piece of paper represented your stake in a company. It was very inefficient because whilst this created a new way of raising capital, to trade it, you would actually have to change the physical certificate for physical cash or any other commodity. This was a huge financial market innovation, but it wasn't really fit for scale to create a financial ecosystem at the financial market. And so as this market scaled, a number of regulators as well as larger financial players noticed the need for central securities depositories. Around 1975, you really found a way to immobilize these assets. So a multitude of physical certificates were kept in a safe place called the Central Security Depository, which was one of the first new custodian or new generation custodians, which really created and gave way to secondary trading in financial markets. Over time, as financial markets became more and more global, more jurisdictions or more companies in more jurisdictions started to issue physical certificates, they knew that this wasn't fit for scale and really not fit for a global financial market. And so the physical certificates were dematerialized, not issued on paper anymore, but issued in book entry form, which was much easier to maintain on a global scale. So we completely removed the notion of having bearer assets in the form of stock certificates and really started the way for the financial market, which we know today, which most of it is still registered on triple book entry form. What we're seeing now and what Nomura and I think main institutions are really interested in is how do you move away from this and really look to digitize products to bring settlement to T+0, to create more transparency, to be easier to track what happened, what went wrong, and really to create the next wave of financial service institutions. What we then looked at was really taking this to the digital asset remit. So as you know, and as we'll hear a number of times today, digital assets were created around 2009. Around 2011, it first gained initial retail adoption or early adopters. Those were at the time still keeping most of their private keys or digital assets on cold wallets or physical certificates kept offline. As we know, any Bitcoin or any digital asset works on a cryptographic ledger. You have a public key, which represents your address, and then you have the private key, which is your password, or also a way to move assets from a given wallet to another. If you lose the private key, you also lose on your assets, and so it's very similar to physical certificates. In 2011, that was still very early and very immature. There were a number of technocrats and early users using paper wallets to really store these keys. Around 2013, you saw the first bull market, and the number of early adopters got very wealthy, and so they didn't really trust themselves to keep those physical certificates in their house or in their vault, and so we're looking for initial custodians in the space. At the time, you saw the first custodians come to market, the likes of BitGo or Xapo, which really took these paper wallets and put them in cold storage, meaning ultra-secure safe vaults. This is extremely similar to what has happened with central security depositories, where they simply would take the physical certificates, put them in one safe place, and then allow people to trade it. We looked at this advent, and it's definitely not institutional grade. It would take around 48 hours to get access to these keys, then be able to move one asset to another. So it's really not creating any efficiencies in the traditional market. However, we saw that interest really started to grow. Around 2016, when I think most of the participants in the room started dabbing with digital assets, you had the last hype cycle, And most of the assets weren't kept on paper wallets because most retail users or new market entrants didn't really know how to do it, but they were kept on exchanges. Exchanges really maintained these keys online, really prone to hacks, and so we saw a number of hacks ranging from Mt. Gox, which lost around 4 billion, to one of the most prominent in Japan for our rationale was CoinCheck, which lost around $500 million in digital assets, really because they didn't really know how to manage assets and keep these secure at scale. And so it really started to raise regulatory concerns. Institutional players took a step back because they looked at the ecosystem and they really said that these are risks that they wouldn't be comfortable with. And so an institution like Nomura wouldn't get access to this ecosystem purely because of their security and regulatory risks around that. In 2018, one of our joint venture partners, Ledger, really came out with institutional-grade hardware. They created hardware security modules, which was a new way of storing paper wallets or digital keys in an offline way, but making them accessible very quickly on an online basis. And so with Nomura, Ledger, and CoinShares really looked at the ecosystem and said, now we know that on one side, regulation is evolving. The 2016-2017 market bump and downgrade really created increased questions. There was more interest from an institutional perspective. Government started to look at the ecosystem more actively. And so we looked at it and said, okay, if cryptocurrencies are an opportunity now, how can this evolve to be much bigger to encompass utility tokens, digital assets, and everything as well? Nomura is not a custody bank to date, so we said let's partner with the best-in-class providers in the ecosystem. We partnered with Ledger purely because they had the best technology, and still today they're one of the technological leaders in creating digital asset security. And CoinShares, which is quite well known as the largest digital asset manager. They have a number of exchange-traded products. They have around 5 billion in assets under management, and they really knew how to scale the digital asset ecosystem from a retail phenomenon to bring it to a more institutional asset class, thinking about ETFs and really regulated products. And Nomura, obviously, the Japanese investment bank, over 100 years old, really bread and butter financial services, really understanding regulation, and really bringing an institutional pedigree to the mix. So we announced Komainu as a joint venture in 2018. Nomura never wanted to create a custodian for itself. The idea is really to create a market utility that could be used by not only one bank, but by the whole ecosystem to then be able to compete on other services on top. So we announced in 2018, we got regulated by the Jersey Financial Services Commission in 2019. We then went live to the market in June 2020 with around 200 million in assets under custody. We saw tremendous institutional interest. We scaled 200 million to 2 billion in 6 months. And on the back of that, raised a 25 million Series A to really help the business, on one side, become more independent, but then really scale globally and provide more services. To give a bit of an outline as to what we do, so we have one of the most solid digital asset custody products in the market. We have regulatory approval and strict compliance standards, really speaking to the institutional market space. We're regulated in Jersey. We're speaking to the Singaporean regulator, the MIS. We're actively working in the Middle East. We're working with the JFSA. So every regulator globally understands that digital assets are a competitive advantage. So they're now proactively wanting to create regulation, work with the right players that understand it, and then really replicate it in their market. Because also they know that on one side you have Bitcoin and new assets that will come to market, but on the other side you also have traditional assets which really can get impacted with this new way. We have one of the best technology stacks in the industry. Ledger is one of the providers and partners of ours, which allows us also to have one of the most widest asset coverages. So to date, most of our assets under custody are still purely cryptocurrencies. We have a couple of security tokens, but it's mainly R&D based because there's no significant demand in that space yet. But we can really work to enable stablecoins, central bank digital currency, security tokens, utility tokens, anything that comes with it, including NFTs, really where we see institutional demand and regulatory focus be, we'll really look to work with our clients to enable these assets. We work with insurance to really create insurance coverage, and then in digital assets and given custody is really a new phenomenon. We're looking how can you create additional utility out of custody. So given that clients want to move as little as possible their assets from our solution, given that it's prone to risk, they say how much can we do through Komainu. So we're now really looking to create new utility out of custody, enabling anything like staking and DeFi services, to also enabling more traditional financial prime broker services, anything from trading, lending, on-ramping and off-ramping. And that's the real difference, because back to the point around crypto is only a small focus of it. Financial institutions, including Nomura, are really interested around the Bitcoin ecosystem. Bitcoin as a whole is still less than $1 trillion, so it's very small compared to the grand scheme of assets they deal with. But the things you can do with Bitcoin and other digital assets around staking, decentralized finance, decentralized exchanges, can really be replicated to the traditional financial ecosystem, and therefore can really create and unlock new efficiencies and needs and cost efficiencies for the banks. I'll skip over this, which is simply our secure transaction workflow given on time. But it's very easy. It's working with institutions to set up their risk profile, understanding what the limits are, segregation of duty. So really taking an institutional focus on institutional hat and a regulator hat on top, and really enabling our clients to move assets in and out, Komainu to an exchange or another institution in a very secure and regulated fashion. Back to the assets. To date, I think we have around 5 billion assets in our custody. As you can imagine, given that our clients are mainly institutions, it's very skewed towards the top assets. So it's mainly Bitcoin and Ethereum. But we're seeing more and more interest on anything from stablecoins to central bank digital currency, where we see a lot of developments also with the ECB coming out with new guidance, utility tokens, so new forms of digital assets, including NFTs, which is a very interesting phenomenon over the past year. Over time, and quickly to close, is where do we really want Komainu to go? So Komainu is supposed to become the key enabler for institutions moving into this new digital asset class. So through the custody layer, we really want to give institutions access to the full ecosystem of digital assets. And that's what really institutions are interested in. It didn't take place to date, and it will take a couple of years from regulatory considerations to improvements in infrastructure to take form. But the idea is really for a client to come into the Komainu umbrella. If they have digital assets or not, they can, through us, buy these or sell these. They can trade directly out of custody. We're working with a number of institutional exchanges that haven't come to market yet to really enable efficient trading, and not on the crypto exchanges that we know to date, but more traditional names. One of the companies we announced is TP-ICAP, the world's largest interdealer broker, to really create a wholesale trading venue for institutional clients. We're looking at lending services, where we see most of the institutional demand coming to date. Institutions have huge balance sheets. They want to be able to give or lend out fiat on the back of crypto collateral, and we as an institution are working to enable them to do that in a secure and regulated fashion. As you can imagine, most of these institutions we work with are also regulated institutions, so they have a lot of regulated demands, corporate services, administration, reporting, and anything. On the bottom left, you see what I'm personally most interested in, because I think it has the most impact. So how can you take new business models that digital assets give wave to into the traditional ecosystem? And so we're looking at anything from staking services to DeFi enablement, where we're working a lot with regulators to create clarity and regulation on top of it. How can you exchange two assets without having a counterparty in the middle? How can you lend on assets through a smart contract without having a lender or a central counterparty in the back as well, to create efficiencies, be more transparent, also remove some of the risks within the ecosystem. And potentially the most interesting pillar that we'll hear a lot about today, but I think is the most underdeveloped, is really tokenization of traditional assets, and then Web3. Anything around new assets, NFTs, how can you use those, what are the use cases, digital vouchers, anything that come with it. We're really at the forefront to work with a number of startups, institutions, regulators, and I hope I'll meet many of those today, to really enable the next wave of this technological advancement, and then really understand how we can institutionalize it, how we can create the right rules in place to really foster adoption on an institutional landscape. The market will only become so big as soon as institutions enter, and I think the most interesting data point is that whilst this market we see, and everyone's quite depressed because of the market downturn, it's the first time that I really see more and more institutional interest. Every downturn represents an opportunity, and this time institutions, or most institutions, have the right infrastructure and right partners to take this opportunity in-house and really build on top of it. And so I think that the next cycle will be the one that really takes digital assets into the mainstream. Thank you. I'm available for any questions afterwards.